You're listening to Seattle Real Estate Podcast.
Today, talking about taxes. We're talking about taxes. Taxes are going up. We know taxes are going up, right? Because after that last election, there is no way taxes are going to do anything but go up. That's right. They are. We know it. You guys know it. Other people know it. Let's not try and pretend. It's going to happen. Here are some things. Here are some precursors to what I see. Taxes going up. After the GameStop fiasco, momentum builds for an $800 billion financial transaction tax. Second article I'm going to read is Janet Yellen, Secretary Treasurer, favors higher company tax, higher corporate tax, and signals a capital gains tax is worth a look. Let's just take a look. We're not going to buy today, but we're going to take a look. That's what we're talking about. If you're new here, thanks for being here. My name is Sean Reynolds. I own a couple of real estate companies, and I read the news that you guys like to hear. Let's jump on in. GameStop fiasco. Fiasco, such a strong word. It builds momentum for an $800 billion tax with a B. This is from CNN Business. CNN regular, not so good. CNN Business, I can kind of tolerate sometimes. But this one, it had a decent article here. Uncle Sam is in search for a pot of gold that could ease the pain of trillion-dollar deficits. It's like the hangover, the day after the hangover. Oh, man, I am really going to have to pay for all this, aren't I? What am I going to do? Where am I going to get that money? Oh. And some believe Wall Street might just have the answer. Doesn't that just sound funny? Wall Street having an answer to something? No, they have an answer that is self-serving, typically. For more than a decade, progressives have tried and failed to impose a financial transaction tax. But there is new momentum for such a levy as the national debt skyrockets during the pandemic and in the wake of the GameStop trading frenzy that shined a bright light on market structure concerns. We have concerns over the market, therefore we shall tax it. And that's kind of what we're saying, right? Hey, look at this. We could pay for a lot of this debt here. Don't try and reel in spending or anything. Just tax it. Tax some more. Because like states of California, I mean, they have proven that theory has worked out so well. It's just been so swimmingly. None of their residents, none of their big corporate companies, none of them are leaving, are they? No, we know that's just not true. It's the opposite, right? They're like, I'm out of here. Who was it? I forget what rapper was it who said, 60% in taxes? Are you out of your effing mind? I mean, he tweeted that out, and he was talking about being in California, and after he added up all the tax structure, he's like, are you kidding me? It's crazy. I can't remember who that was, but it was funny. It was a funny tweet. The White House told CNN Business on Sunday that a financial transaction tax on GameStop-like trading deserves additional study. It deserves additional study. We need to look at this further and can be part of a greater evaluation of such a tax for revenue and market stability. We're going to calm the markets down by taxing you, the investor, some money. That's going to create market stability. The leading proposal amounts to a $1 tax on every $1,000 worth of transactions. But there is a deep divide over the wisdom of a financial transaction tax. Progressives see it as a smart way to simultaneously curb predatory trading. How are you curbing predatory trading by taxing something, while also funding ambitious programs aimed at easing America's inequality problem? That is some nonsense right there. That's just some nonsense. Opponents, on the other hand, paint a financial transaction tax, an FTT, as a nightmare. Wall Street would take a hit, and it's already warning such a levy would backfire on Main Street investors by raising trading costs and depressing market liquidity. Okay, it raised trading costs just a tiny little bit, but not a lot. But it doesn't matter because the cumulative effect is they're going to tax the whole market as a whole, right? Going to raise some money. and they're going to be depressing market liquidity. That's a stretch, but I kind of see where they're going there. The odds are still against a financial transaction tax being enacted, but for the first time in a decade, this proposal should be considered as a viable policy option rather than just another talking point. Let's rethink a financial transaction tax. Let's just consider it. We're not going to do it. We're just window shopping here. Let's talk about it. Maybe we'll talk more in depth behind closed doors where we have a little bit more freedom to kind of think what we really like. We just want to tax something and somebody, right? We need to come up with some ways to tax people. So let's couch it in these terms where everybody feels so much better about paying more money to the government for services that they don't really get. Last week, House Financial Services Chairwoman Maxine Walters says she's very interested and certainly looking at a financial transaction tax. We're looking. We're not talking about it quite yet. We're just window shopping. Mind-boggling concentration of wealth. Don't you love these stories? It's like, okay, so some people worked really hard and got where they are. Other people inherited some money. But because people have money, you should just tax them willy-nilly. Lawmakers will surely be tempted to tax transactions because it could raise vast sums of money at a time when Washington is strapped for cash. So they're looking. Washington's looking all over the United States. Where can we rustle up some more money? Because, man, we just spent our way out of the pandemic. Not sure if that really did what we wanted it to, but we kind of had to. We had to do something. That's what we did. Now we're strapped for cash. We need some money. A 0.1% tax on stock, bond, and derivative transactions could raise $777 billion for the federal government over a decade. It's according to a 2018 estimate by the Nonpartisan Congressional Budget Office. Okay, so you're going to raise, call it $800 billion. Let's round up. Let's not be petty here. $800 billion over a decade. And you just spent how many $1 trillion during the whole coronavirus thing? Look at, what's that number? How much is that number? Does this even make sense? I mean, you're going to have to do some heavy taxing to get us to work our way out of all the debt we're in right now. We have tremendous income equality in our society and a giant deficit. A financial transaction tax would be an incredibly efficient and progressive way to raise revenue. Aaron Kline, a former Treasury Department official in the Obama administration, told CNN Business. Interesting. The top 1% of American households would pay 40% of the total amount of the tax, while the bottom 60% would pay just over 11%. I feel so much better already. Oh, tax me. According to the Urban Brookings Tax Policy Center. That makes sense because the wealthiest 10% of U.S. households owned 87% of all stocks and mutual funds, according to 2020 data from the Federal Reserve. The concentration of wealth in the stock market is mind-boggling. Therefore, we should tax the F out of it, said Kline. He didn't say that second part. I said that. Who is now a senior fellow of economic studies at the Brookings Institution. Even though some argue an FTT would be a disaster, the tax we're talking about would be a disaster. The United States already has a tax, I'll bet a very tiny one. Roughly 2 cents per $1,000 traded goes towards funding the budget of the Securities and Exchange Commission. So jack that up 50 times and you're at $1. That's what we're talking about, right? Due to surging trade volume during the pandemic, the tax rate to fund the SEC is being lowered to just half a cent per 1,000 starting Thursday because you got so much volume going on, right? There is a fee today and the world hasn't ended, said Dennis Kelleher, CEO of Better Markets, a group that lobbies for tougher oversight of Wall Street. The proposed fee is so puny that no reasonable retail investor would ever even notice it. Okay, but where does it stop? We're talking about this. My thing is, you're just going to get taxed and taxed and taxed again. And that's why so many of you guys, great listeners, great viewers, you're saying, hey, let's start covering capital gains tax. Let's start covering the FTT tax. Let's start covering raising income taxes. Let's start covering income tax in the state of Washington, where we don't have one, because that's a coming. The financial industry is arguing the exact opposite. They don't want any more taxes because it impacts their business. They say even a 0.1% levy on transactions will cause market players to pass the costs on to consumers and make it harder to buy and sell securities by decreasing liquidity, which measures how easy it is to buy and sell securities. Some Wall Street firms even could try to move their operations outside the country to avoid the tax. That would be interesting, wouldn't it? Just a bunch of offshore companies. Hey, what are you doing? Yeah, I had to move my company. Couldn't take the tax. Tax is a no-go. I'm a no-tax guy. Move the company offshore. The New York Stock Exchange recently threatened to flee New York, possibly for Texas, in response to transaction taxes mulled by Albany. Good. I hope they do move. F you, New York. We're not staying here. We're not taking this ridiculous transaction tax being mulled by leadership. No, we're just like Joe Rogan. We're going to hit the road. We're going to Texas. Although Texas at this point, how about Miami? How about South Beach, Miami, where it's warm and you've got more freedom? What about there? I like Miami. Miami's fun. This approach has a long history of unintended consequences that will penalize workers, pensioners, and American families, a spokesperson for the Coalition to Prevent the Taxing of Retirement Savings. Again, man, these groups, Coalition to Prevent the Taxing of Retirement Savings. That's the name of this group. They told CNN Business. That coalition includes the New York Stock Exchange, NASDAQ, and UBS. Citadel Securities and Virtual Financial, two high-speed trading firms that would be hurt by financial transaction tax, are also members. An FTT, tax we're talking about, will increase trading costs for investors, including individuals, undermine the competitiveness of our capital markets, and harm the U.S. economy just as we work to recover from this pandemic, the spokesperson said. So you got some pretty different perspectives on the same tax, as you always do, right? Some countries tried and failed. James Angel, a Georgetown University professor who specializes in market structure and regulation, authored a Chamber of Commerce funded paper in 2019 that found a financial transaction tax would hurt Main Street by driving up the cost of trading by more than the amount of the tax. Imagine that. There is no such thing as a tiny tax that raises big revenue, Angel said in an interview. He pointed to how some other countries, most notably Sweden in the 1980s, abandoned such taxes after trading volume vanished and revenue underwhelmed. Of course, the United States, with its deep financial markets, massive economy, and the world's reserve currency, is not Sweden. So making that comparison, maybe not as relevant. It really messes up the market, Angel said. If U.S. trading volumes fell sharply, the FTT wouldn't raise nearly as much as the $770 billion the CBO estimates. Greg Valerie, he's chief U.S. policy strategist at AGF Investments, said the chances of a financial transaction tax are very slim because moderate Democrats would unlikely to back it. There you go. All right. So that's why we're talking about it. We're kind of looking at it. We're kind of considering it. Everybody knows, this doesn't really have a chance to get through, but maybe down the road, we'll reimagine, we'll rethink an FTT. Maybe we will. Maybe for now, we're just going to talk about it and consider it. Don't really know. It would be a disaster. It's a Pandora's box that should not be opened. It's kind of how I think about taxes in general. There's already enough. If you can't figure out how to get where you need to be with your current budget, maybe you need to start making some cuts. I don't know. That's just me. Of course, it's impossible that FTT proposals in Congress get scaled back, including by lowering the rate or excluding smaller blocks of trades. We don't even know what they're going to tax at this point, how they're going to do that. I mean, it's so far off, but the fact that we're talking about it, I think that is what's important. It's important to look forward and go, okay, what taxes are we going to have? And that's why I'm covering this, just to kind of get an idea. All right, here's what's on the table, maybe a little bit-ish. We're thinking about it. During last week's congressional hearing on GameStop and Robinhood, Citadel Securities founder Ken Griffin warned a tax would boomerang. We firmly believe a financial transaction tax would injure Americans trying to save for retirement, Griffin said. And that's a lot of my heavy-weighted demographic is you guys that are either getting close to retiring or are retired or maybe just retired. You make up a large portion of my viewership and my listening audience. So that's why I'm going to be kind of covering some more of this stuff. I'm okay on taxation. I'm better on real estate taxation than I am. I've got a little bit of corporate tax background just from paying corporate taxes as owning a couple of corporations, but that doesn't mean a ton. I'm better on real estate taxes because they're simple for the most part, right? How much am I going to pay when I sell my house? That kind of thing. The GameStop trading frenzy drew attention onto how Robinhood was able to bring zero commission trading to the masses. Oh, if there's zero commission, we need to tax that. We got to tax this. Through a controversial practice known as payment for order flow, Robinhood and other brokers get paid to route retail trades through market makers like Citadel Security. They still get paid. Payment for order flow has made it cheap and easy to trade. However, critics say it's really Wall Street that is getting the better end of the deal by skimming pennies off each trade and racing ahead of retail orders to make a profit. We believe the markets today are rigged to favor high-frequency traders, said Kelleher, the Better Market CEO. The industry has taken visible upfront commission fees and disguised it into an invisible payment for order flow. In other words, it's not really free to trade. I mean, you just take a look at a business model like Robinhood and you're like, okay, there's no such thing as a free ride. What's the deal here? Well, they're basically charging a tiny, tiny little bit based on volume. And man, volume has been good. Lots of volume going on, right? Kelleher thinks Congress should focus on taxing orders, not transactions, because a staggering amount of all stock trade orders, some estimates say 99% are canceled because of high-frequency trading strategies. Critics say those orders are evidence that high-speed traders are manipulating the market by creating the appearance of demand where there is none. Uh-oh. You mean to tell me that somebody might be rigging this? That's something we need to look into, right? No, I mean, you just know all this stuff. I mean, even what the GameStop traders were doing, they were basically kind of rigging it on their own that, hey, if we buy enough of this up, we're going to force these short sellers. They're going to have a pretty tough position. Let's just buy everything up. And due to our numbers, let's see what kind of damage we can do. They did a lot of damage. Good for them. A financial fee on orders could be the death knell for predatory high-frequency trading, he said. Everyone will be better off, except for the predators. Man, we're making this dramatic, right? All right, let's go see what Janet Yellen is talking about. Janet Yellen favors higher company tax, higher corporate tax, signals capital gains. Again, worth a look. Not really shopping today. We're just looking. Capital gains tax, increasing that. Let's just take a look. But, just again, we're just kicking the tires. We're out looking at a few homes. We're not really in the market to buy. But something popped up. Attractive enough tax popped up. We might take a look at that. Let's just look. Treasury Secretary Janet Yellen said President Joe Biden favors. What's so interesting is we are in February 23rd. I mean, we are past a month of the new administration basically being up and running. And I haven't mentioned President Joe Biden's name in, I think, a single podcast because it's like not a factor. Has he done anything? I don't know. I know he did a bunch of executive orders that were just like, what? What are you doing? Oh, yeah, of course. Silly stuff. I mean, he's got that going on, but it's just, even in the news stories I'm reading, there's no Joe Biden. What's going on? What's happening there? We need some follow-up on that. What is literally happening at the White House? Don't know. Don't really hear about it. I could probably dig deeper, but again, I'm more interested in covering this stuff because this is the nuts and bolts that affects you guys out there. Biden favors boosting taxes on companies, surprising, and signaled openness to considering raising rates on capital gains. Everybody knew that one was coming, while still steering clear of a wealth levy. Capital gains kind of is a wealth levy. You're just basically taxing the rich people. I mean, you just are. And not a fan, but whatever. A wealth tax has been discussed, but it is not something President Biden favors, Yellen said at a virtual conference on Monday hosted by the New York Times. Interesting. She said such a tax would have significant implementation problems. Can't get it to work, therefore we won't do it. The administration is looking to boost the corporate tax to 28%, Yellen said. So it went from 35% down to 21% where it is now. And the economy, when President Trump was in office, was roaring. It was going. It was going ham. And then the coronavirus happened. And then we shut down all of our economies. Not a good thing. That was painful. Treasury chief said last week that revenue measures would need to be help pay for Biden's planned longer-term economic reconstruction program to help address concerns about debt sustainability. We've got a massive, massive national debt now, right? I mean, it is massive. I always joke, and I don't know how many levels we need to go, but we're basically borrowing money from our children's children's children, our great-great-grandchildren's children, is something like that. And that's if anybody ever pays this debt up, right? I mean, I don't have to, it's going to happen way after I'm dead. Won't care. But you're like, okay, this can't go on. We can't keep borrowing into the future forever. So what's going to happen? Something's going to happen, and it's probably not going to be good. I'm just going to throw that out there. Yellen also said that a hike in the capital gains tax might be something worth considering, quote unquote. Asked about a financial transaction tax, she said, one would have to examine closely what effect it would have on ordinary investors. All right. Turning to climate change, which is set to be a new focus for the Treasury, Yellen said the department may be able to help coordinate climate-related stress tests on banks and insurers through the Federal Reserve or other regulators. All right. That's just a different angle we're going. The Fed already conducts tests to address vulnerability to economic or market downturns and uses the results as a basis for financial institutions' capital requirements. All right, this is what would happen. Stress tests. You guys kind of know about that, I'm sure. I always assume that you guys basically know more than me because a lot of these topics, they're outside of kind of my expertise, which is basically residential real estate. And so I don't usually break them down, but stress tests, like banks have stress tests, what would happen if this financial scenario happened? What liquidity do you guys need to get through this? You're going to have to pay out a whole bunch of stuff. How much money are you going to be left with? All right, here's your liquidity requirements as a result. How much cash on hand are you going to need to get through this? Any climate-related tests aren't expected to have the same status in terms of limiting payouts and capital as the regular assessments, Yellen said Monday, but they're coming. Asked whether the Treasury would consider issuing a 100-year bond to take advantage of low yields, Yellen noted the government already sells long-term debt. While the Treasury could look again at new securities, market professionals think the demand for a 100-year bond would be very tiny. That was in quotes. It would probably be a very thin market, she said. The current longest dated Treasury note is a 30-year security. Yellen also said that she hadn't anticipated an offer by Biden to become Treasury Secretary at a time when she was focusing on research while working at the Brookings Institute. And then she talked a little bit about Bitcoin. Here's her takeaway. This is all you need to know about Janet Yellen and Bitcoin. I don't think that Bitcoin is widely used as a transaction mechanism. It's not, really? Okay. You might want to check on that. maybe not widely used, but it's definitely used. And I think it's becoming more and more prevalent. And people are like, what about this crazy Bitcoin we keep hearing? I don't know. It's had a big run, hasn't it? And then Bitcoin kind of, it had a drop in value after she made those comments because people are like, is this true? Anytime somebody makes a comment about anything, everything just changes, right? Somebody tweets something out, the world just kind of explodes. All right, so those are some of the situations moving forward. I'll keep my eye out on the whole taxation thing. Capital gains tax, that seems to be a big thing people are looking at. And that's because you guys, my viewing audience and listening audience, let's be honest, you guys have some money. You guys have some money squirreled away. And you don't want to be taxed on capital gains when you sell this stuff, whatever it is. You've got money squirreled away. You've got assets squirreled away. You're at that point in time where you don't typically have kids that need a lot of financial assistance. Maybe you're helping them buy a house. Maybe you're helping them get a business going. Maybe you're helping them buy a car, kind of those big ticket items. But you don't have little Johnny at home who you got to feed, clothe, and all that stuff. Your kids are probably more out the door. That's most of my demographic. And so that's why I'm going to kind of commit to when I do see a story on taxes, especially capital gains, that impacts you, I will read those right to you here on the Seattle Real Estate Podcast. So even though it's a real estate podcast, we talk about other stuff that I think impacts our demographic. So that's what we're doing. That's what we're doing here. Thank you for being here. Thanks for being a part. Love to have you subscribe. Love to have you hit that like button, whatever it is. Hit that notification, all that stuff. You guys know what to do. I don't have to tell you. You guys can do it. And thanks for doing it. Thanks in advance for doing it. I will see you guys on the next one. Stay safe. Bye for now. Don't forget to subscribe to our channel and hit the notification bell so you'll know when our next video is out.